Welcome to a deep dive, the market lately. It's felt a bit like trying to navigate through shifting sands, hasn't it?
Yeah, definitely. A lot of sudden moves.
Exactly. We've seen a lot of those, trade tape bombs, things that just create instant nervousness.
And that leads investors to kind of pull back,
Yeah.
sit on the sidelines.
Yeah, even after we saw some bounces like that Springs Ricochet rally earlier this season, people are still hesitant. And you hear a lot of chatter about the usual suspects, the familiar worries, rising yields, a weak dollar, oil prices falling.
Mm-hmm. And conventional wisdom often paints those as, well, pretty negative signs, trouble ahead kind of thing.
It does. It feels like the standard interpretation.
Mm-hmm.
But our source material today, it's a piece from Alec Young over at moneyflows.com, dated June 9, 2025.
Oh,
It takes this really fascinating, almost contrarian view.
okay.
It looks at this exact same nervous market, all the fear, the defensive positioning, and basically argues that the bullish parade isn't stopping,
Ah, so the opposite conclusion.
pretty much. And that actually going higher is the real pain trade for everyone who's sitting out.
Interesting. So it's deliberately challenging that common narrative.
Exactly. So our mission for this deep dive is really to unpack that core argument. The source says there are three bullish forces that will drive stocks to all-time highs.
Okay.
And we need to understand why they think those widely held bearish beliefs, about rising yields, weak dollar, falling oil, might actually be, well, according to this analysis, completely wrong.
Got it. So digging into the why behind that contrarian take.
Right. We'll look at the data they provide, the reasoning, just to get a handle on this specific viewpoint and, what it could imply for the market. Maybe it'll prompt you, our listeners, to think a bit differently about these signals too. All right, let's unpack this.
Okay, so maybe starting with setting the stage, acknowledging that common view we just mentioned. You have pundits, investors looking at rising treasury yields, a weakening dollar, falling oil.
Yep.
And their first thought is, this signals economic doom.
That's the story you hear almost everywhere, yeah. It feels sort of intuitive, doesn't it?
Yeah.
High yields cost more. Weak dollar sounds bad. Falling oil must mean demand is crashing.
It does. But this source, right out of the gate, says that interpretation couldn't be more wrong.
Whoa.
Yeah. It argues these are actually significant bullish forces.
Okay, that's quite a claim. Let's tackle that first one then. Rising yields and a weak dollar. The source says that's bullish. Can you walk us through what's actually happening there and why it's making folks nervous?
Sure. So what we're seeing right now is treasury yields have been ticking up, while at the same time the U.S. dollar has been weakening against other currencies.
Okay.
And this combination, this divergence, it isn't the most, let's say, frequent pairing, which is exactly why it causes some jitters.
Right, it raises those big questions like, is capital fleeing the U.S.? Is the dollar losing its reserve status? Is U.S. exceptionalism over? That kind of heavy stuff.
Exactly. Those are the underlying fears. But the perspective in the source is that while it's maybe unusual, it's more likely short-term noise.
Not a fundamental breakdown.
Not a deep structural shift in the economy or the market. That's the argument presented here.
Okay, interesting. So maybe not panic stations just yet.
Yeah.
But is this pairing, rising yields, falling dollar, is it really that rare historically?
Well, according to the data they cite, it's relatively uncommon. They looked back quite a ways since the late 1970s.
Okay.
And they found that looking at the trade-weighted U.S. dollar index, seeing it fall while 10-year treasury yields were rising, that only happened about 16% of the time.
16%. So yeah, it happens, but definitely not the norm.
Right. And that rarity feeds the nervousness, like you said.
But here's the twist, isn't it? The counterintuitive bit the source brings up. When you actually look back since the 70s, does this rare combination really spell doom for stocks historically?
And this is where it gets really interesting. Surprisingly, no. Quite the opposite, actually. The data they present shows that stocks don't just, muddle through. They often thrive in this kind of environment. Since 1977, the S&P 500 gained an average of 14%.
14%.
In the years following periods where you had those 3-month dollar declines alongside increases in 10-year yields.
Wow, okay, 14% average gain. That historical data point just completely flips the script on the fear around this specific mix, doesn't it?
It really does.
So if the history is so positive, why? According to the source, why does this combination historically lead to good stock performance? What's the mechanism?
Well, they point to two key things. First, they mention the current inflation picture, core PCE inflation. The Fed's preferred measure, it's relatively tame right now, around 2.5%.
Right.
So in that context, rising yields aren't necessarily screaming inflation problems. Instead, the argument is they largely signal better than expected economic growth.
Okay. So strength, not stress.
Exactly. And they give examples. Goldman Sachs, the Atlanta Fed, both forecasting Q2 real GDP growth above 3%. That kind of strong growth, the analysis says, is ultimately good news for earnings.
Okay, that makes sense. Rising yields reflecting a stronger economy, which helps company profits. That challenges the standard fear narrative. Now, what about the other part, the weak dollar? How is that a positive?
Well, a weaker dollar is described here as a pretty clear equity tailwind.
A tailwind. How so?
The source reminds us that, roughly 40% of S&P 500 revenues actually come from overseas.
Right, big multinationals.
Precisely. So when the dollar weakens, all those earnings they make in euros or yen or whatever, they convert back into more U.S. dollars.
Okay, so it directly inflates their reported profits.
Exactly. Gives a nice boost to the bottom line. So
Yeah.
rather than being a problem, it actually helps profits for many of the largest U.S. companies.
An equity tailwind.
Yeah, that makes a lot of sense when you think about how global these big S&P 500 companies are. Okay, so according to this source then, myth one busted. Rising yields plus a weak dollar, in this specific context anyway, equals growth signals and earnings boosts, not doom and gloom.
That's the argument.
All right, let's move to the second big bearish belief this source tackles. Falling oil prices. We've definitely seen that. WTI crude, down about 19% over the last year, from around $78 down to $63.
Yeah, that's the trend. And the reasons usually cited are, plenty of supply coming from the U.S. and OPEC plus OO, combined with maybe some uncertainty about future demand.
Right. And the typical interpretation is, well, falling oil must mean global demand is slowing down, and that's got to be bad for the economy overall.
That's the standard take, yeah.
But this source argues the opposite. It calls lower oil prices a hugely bullish, under-the-radar macro driver.
Exactly. They frame it as this really significant positive factor that maybe isn't getting the attention it deserves. Under the radar. Okay, how does falling oil turn into a bullish driver? What's the connection they're making?
The main mechanism they focus on is the boost it gives to real consumer spending.
The consumer.
Yeah. I mean, think about it simply. When gas prices fall at the pump, people have more money left over, right?
Right. Extra cash in the pocket.
And that extra discretionary income can then be spent on other things, goods, services, going out, whatever. It fuels spending across the economy.
And the consumer is what, like 70% of the U.S. economy? It's massive.
It's huge. Roughly 70% of all economic activity. So anything that gives consumer spending a meaningful lift is a pretty significant positive for the whole economy.
Okay, that makes intuitive sense. Lower energy costs free up spending elsewhere.
Yeah.
And what about stocks? How do they typically react historically when oil prices are weak like they have been?
Well, the data they present here is also pretty compelling. The stock market actually tends to react quite well. Yeah. Looking back since 1968, the S&P 500 has gained an average of 14.1% in the years that follow bottom quartile performance for crude oil prices.
Another 14% average gain. Wow. So that historical pattern strongly supports their case that falling oil is actually a tailwind for stocks, not the headwind people often assume.
That's the conclusion drawn from that data, yes.
Okay, so let's pull these threads together. We have rising yields signaling growth because inflation's contained, a weak dollar boosting overseas profits for big U.S. companies, and falling oil prices putting more money in consumers' pockets and historically correlating with strong stock returns. Those are the three big bullish forces this source highlights. How does it connect these dots for the overall market picture right now?
Well, the synthesis is basically that these aren't just, isolated data points. They combine to create some pretty strong bullish tailwinds for the stock market overall.
Okay.
And this, according to the source, is the underlying reason why you've seen, quote, money flowing into stocks while the crowd sits and stares.
So while many are sort of frozen by fear, reading these signals the conventional way.
This analysis suggests there are these fundamental forces, backed by historical patterns, pushing the market higher.
Right. So given that view, what does this mean for, say, portfolio strategy? How should investors be positioned, according to this specific analysis?
Well, based on these tailwinds and the historical data they've laid out, the source takes a very clear stance on positioning. They even mention having advised buying mega-cap tech stocks back on May 5th, calling it a good one and suggesting it still has room to run.
Which really contrasts with what you often see happening now, doesn't it?
Huh.
A lot of investors trimming back on cyclical stocks, the growth names, and maybe leaning more into defensive sectors because of all the uncertainty.
It absolutely does. And the source is pretty blunt about it. They explicitly call that move, rotating into defensives because you're nervous a mistake in this particular environment.
A mistake.
Okay. And I assume they back that up with data, too, like which sectors tend to do well when oil is weak and maybe yields are behaving this way.
Exactly. The analysis points to historical performance again. Looking back since 1968, in those years following bottom quartile oil price performance, sectors like technology significantly outperform.
How much outperform?
They show tech beating the average by about 5.8%. But in stark contrast, the defensive areas like consumer staples and healthcare, they lag badly in those same periods. Staples averaged just 0.7% gain, and healthcare actually averaged a slight loss, neither 0.7%.
Wow, that's a huge performance gap. Really dramatic. It certainly underlines the message derived from their data, which is expect a risk-on environment.
That's the term they use, yes, a risk-on environment. And the clear implication for portfolios based on this view is favoring growth stocks, primarily from cyclical sectors, and avoiding bottom fishing in defensive areas.
Right. Stick with growth. Avoid trying to find bargains in the defensive names right now. That's the message. The source even makes a point of saying they believe they got this directional call right over the last couple of months when, quote, most research houses got it wrong.
Okay, bit of confidence there. And it's worth noting, too, for their paying subscribers, their pro members, the source actually provides specific stock lists that align with this whole thesis.
Right. They mentioned like a top 10 NASDAQ 100 stocks list based on some proprietary score. They use a MAP score, I think they call it.
Right, measuring strength and attractiveness.
Yeah. And conversely, a list of 10 defensive names that score poorly, the ones to potentially avoid. So it shows how they try to translate that big picture macro view into, actionable ideas for their readers.
Okay, so let's try and wrap this up. What does this all mean? We've taken a pretty deep dive into this specific source material today, and it really offers a strong challenge to some common market fears, doesn't it?
It really does.
It argues that this mix rising yields with a weak dollar, plus falling oil prices, isn't the doom signal many think. Instead, it sees them as pretty significant bullish forces for stocks, and it backs that up with historical data.
Leading to that conclusion of a risk-on environment that favors growth and cyclicals over the defensive plays.
Exactly. It's a fascinating, definitely data-driven and contrarian perspective. It really highlights how these different economic signals can interact in complex ways, and what those interactions have historically meant for the stock market.
Yeah, it shows things aren't always as simple as the headlines suggest.
For sure. Now, remember everyone, this deep dive wasn't financial advice. We're just exploring one analyst's specific, data-backed view on what's driving the market right now.
It's just unpacking their perspective.
Right. But it really leaves you with a provocative thought, I think. In a market that's just swirling with conflicting signals and these kind of standard narratives, how much should we lean on those easy, seemingly intuitive interpretations of economic signs? And how much should we maybe dig a bit deeper into the actual historical data, the underlying mechanics, to see if the picture is maybe more complicated, or perhaps even, like this source suggests, surprisingly contrarian? It makes you question those quick assumptions, doesn't it?